You're listening to the Breakaway Wealth Podcast, the show that helps you build wealth faster, think outside the box, and break out of the herd. Here's your host, Jim Oliver.
Section 6, Lessons from History. What's the history of life insurance? What are some of the things that we need to understand about the gold standard, etc.? We're going to bring it all together here so that we don't repeat history and we make the right decisions. Here we go. Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and with me today is my co-host, Nick Costco. Welcome, Nick.
It's a pleasure to be back on and dive into this, the sixth section of the case for IBC.
The sixth session and almost wrapping it up, right?
Yeah. So those of you that are just joining us, we have been spending the 7-part series here of diving into Nelson's last published work called The Case for IBC. If you want to get a copy of it, just go to infinitebanking.org, go to the store, get a copy. It's a quick read, a little over 100 pages, and it's a great compilation of Nelson, Dr. Bob Murphy, and Carlos Lara sharing their wisdom on why infinite banking can be for you.
Absolutely. So let's just jump in. So this chapter is lessons from history. And, in this chapter, they kind of give you an overview of some subjects that are in the book, how privatized banking really works. And if you want a bigger or better or more detailed explanation, I would go to that book. But I also would encourage everyone to read Human Action by Mises in 1949, because he talks about saving inside of insurance and why that's important and what it does from an economic standpoint.
Yeah, and if you're really looking to go down the Austrian economic rabbit hole, go to Mises.org. It's a great resource for a lot of great reading.
Absolutely. So, when they're talking about the gold standard, Nick, what's the easiest, quickest way to explain the gold standard to somebody?
The gold standard was our money was backed by something physical. World currencies were backed by gold for hundreds of years, right? And we would use something that was easy to exchange, like a paper money, just for ease of transactions, right?
Absolutely. And so, we were on the gold standard, and then really how Nelson would explain it is what happens in wars and who's backing and financing the wars. World War I really started destroying the gold standard. But then in 1933, this is the thing that I think is important and people need to realize that this has happened in U.S. history, is during the Great Depression, FDR, he took an emergency action and he required Americans to turn in their gold. Now, under there was a penalty of prison.
Yeah.
Right.
This was the government, the people's choice, just overtly stealing from them, frankly.
Yeah, gosh, that doesn't happen today, does it? But so, and then they would revalue the gold at $35 per ounce.
Yeah,
right.
That's right.
But before, if you were a citizen, you could take your gold down. I mean, you could take your money and redeem it for gold.
That's right.
From that point on,
yeah,
you couldn't, and only foreign governments and central banks could do that.
And there's always a great cover story, right? Like, hey, we need this to fight this war. We need this, right, to save you. There's always that. Yeah, I won't go down that rabbit hole, but that's how this was sold to the people.
Right. And then Nixon finally put the last, put it to bed, so to speak. And in 1971 took us off the gold standard. And that point, even governments couldn't redeem dollars for gold.
Yeah. Well, the thing that I don't want to miss is, we had the Bretton Woods Act, and that when people talk about the US dollar being the world's reserve currency, it's from Bretton Woods. And, we might be, we might have a stinky currency, but we're the least stinkiest in the world because we are the world's reserve currency. Oil by OPEC rule, it can only be bought and sold in US dollar. So that's what's helping, any stability that we have right now, at least in my mind, is rooted in that. And then Nixon, what he did, here's the funny thing is it was all billed as temporary. It was
Oh,
sold to the
yeah.
American public that we go off this, we close the gold window, but only temporarily. And this is
Yeah.
where if you listen to Robert Kiyosaki, he just goes through the roof talking about this event in 1971 and when he was in Vietnam and he started realizing, wait a second, there's going to be a fundamental change in the way the world economy works because of this quote unquote temporary event.
Absolutely. And so now we have fiat money, which is backed by what?
Emotion.
Nothing, right? And so what happened when we got off the gold standard?
Well, now we had this little issue called inflation.
Yeah, exactly. And if you know what's happening, you'll know what to do, right? So that's what
Yeah.
when we think of what happened in 2020 and how much we increased the money supply and how much we're going to increase the money supply in 2021 and all of these things that are happening, I'm just telling you, we have to do something, right? But we're not going to go down that rabbit hole. All right. So there's something else that happened 3 years later.
Yes.
What was that?
Yeah. So 1974, ERISA was enacted, and that birthed the IRA, and a few years later birthed the 401k. So I think about it's the birthing of giving up control of your money to other people.
Absolutely. Absolutely. What it did is saved Wall Street. So if you look at what the government is doing, right? The government's protecting itself, protecting the banks, protecting Wall Street. Where is it protecting the citizen? Where is it protecting the taxpayer? The
Yeah.
taxpayer really is the host, right?
Yeah.
The parasite of the government lives off the host, but it's never protecting, it's consuming the host.
Yeah, that's right. Like uh, it's really theft, but it's always done. So remember how we sell with emotion and then we have to follow with logic. And it's always, hey, we're here to help you. We're serving you. You got to do this to help your brethren. But if we dig in and apply any logic to it, there's really no logic to it.
Right. So if you look at there's a table 3 increase in market values of individuals' financial assets total and by components 1950 to 1985, right?
Yeah.
But let's just look at one area for a minute is life insurance reserves, right? This is where people held money and in 1950, 19% of somebody's net worth or whatever was held in in life insurance.
Yeah. So it was a percentage of the total increase in financial assets in 1950 was due 19% was due to life insurance reserves.
Right. And in 1985, 2%. So what was that basically saying?
People were moving money out of that and transitioning and putting money where? Well, we just gave you the clue. It's moving to Wall Street, and if you look at the run up of Wall Street, it was because we were transition. People were basically being incentivized to put money there. It wasn't because people thought, hey, that's such a better value. It was just sold that, and naturally, if people through IRAs and 401ks and the employer, the corporate benefit to having a 401k for your employees, well, of course, if you put more money into it, it's going to go up. But it wasn't necessarily because people saw value in it. It was just incentivized to the employers.
And they got a tax break, a pretty
Yeah,
substantial tax break to do it, right? So think again, who's controlling that play?
that's right.
And
It's a government program, as we said on a previous episode. All government programs have wound up doing the complete opposite of what they were intended to do.
and then he talks a little bit about the briefly about the FTC report where and that's the Federal Trade Commission in 1979 that kind of said, hey, whole life insurance isn't a good place to put your money,
Yeah. Well,
right?
Ralph Nader didn't care for the fact that you can't see all this breakouts, a bundled thing, right? We've talked
Yeah.
about that before. It's bundled. And so what came of this?
Is it universal life?
How well has universal life worked out?
Well, in the last 40 years, it's failed twice. And I would say it's failing again because it's not doing what it's projected to do.
Yeah, it's just a fancy illustration. It looks good. It's for somebody else though. It's not for the consumer at the end of the day.
Right. Right. Exactly. It puts all the risk on the consumer. And some of these insurance companies said, hey, you know what? Look at ERISA. Some of these citizens, they'll take all the risk. They're taking all the risk on the do-it-yourself defined contribution retirement. So
Right.
why won't they do that with their life insurance? Oh, they will. All we got to do is give them an incentive and make it look really pretty,
Yeah.
right? Okay.
Jim, if we were starting a life insurance company, would we if we wanted to be profitable, would we sell as the owners, would we sell universal life or whole life?
We would sell universal life because nobody keeps it. We never
That's
have to
right.
pay a benefit.
That's right.
So, or we would sell term insurance where less than 1% ever pays a benefit because there's only one benefit.
That's
A
right.
universal life is term insurance. Invest the difference. Invest the difference in what? High interest rates. Oh, we don't have high interest rates. So that failed in the 80s. The stock market. Well, there was a couple of corrections in the stock market that blew up all those policies and their projections. Then it was a guaranteed UL. We'll guarantee you have death benefit. Then the insurance companies didn't like the way that looked long term. And then now we have indexed universal life, right? So we try to make it a little bit more complicated with ceilings and floors and some other stuff to make it just so you don't quite understand it. So you think, well, that's what the guy's telling me to put it in my quote CPA or CFP. And so that's what I'll put it in.
Yeah.
All right. So let's look at what happened when, 1986 Tax Reform Act. And we're not going to talk about the different tax brackets and everything else. But the thing that it did is it, it changed life insurance, right?
That's right. It and we talk about this comes up a lot because we're explaining what we're
Where,
explaining the modified endowment contract. What this basically birthed the modified endowment contract, which kind of governs quite a bit of what we're trying to do.
yeah. So what they did is all of a sudden before 1988, you could put as much money as you wanted into an insurance contract, have that 100% of that money or very close or sometimes a little bit more available in cash value, right?
Yep.
And so what were you doing?
Well, I was just
When you
putting
had single premium whole life insurance, what were you doing?
I was just stuffing money into a tax shelter
Because
because I'd never be taxed again, and there was no cost. There was really no risk transfer.
so who was doing that?
The wealthy.
The wealthy. Why, and so that's what's funny is, they say it's hey, this is a bad investment. Don't do this. Don't do this. We're going to do it, but you shouldn't do it.
That's right.
Right. And so then also you had liquidity in the form of policy loans, right? And so then you would put in $1 million, have $1 million available, and then you could borrow from the insurance company $1 million to go put in the motion. And there was no cash drag. It was super efficient, right?
Yeah, yeah, that's right.
Okay, so then they figured out that we're not really doing all of these things that life insurance was intended for. So they came up with the MEC modified endowment contract and the 7-pay test, right? Because they were concerned that too many wealthy Americans were using life insurance to minimize their tax bills rather than, using the death benefit.
Yep. So can you give us a 10,000-foot explanation of the MEC and the 7-pay test? Because I've had the pleasure of listening to you do this well over 100 plus times, but there's so much misinformation out there, and we get asked these questions all the time.
Absolutely. So uh, the important one is the MEC because once a policy would become a MEC, it's always a MEC. Okay, so a simple way to look at it is there's a minimum that you can pay and a maximum that you can pay for a certain death benefit amount of insurance. Who sets the minimum death or the minimum contribution or the minimum premium that you could pay?
Well, we do.
Well, the insurance companies, right? Because they say this is the minimum that we can accept for that death
Oh, I
benefit,
understand.
and so then it's term insurance. There's
Yeah.
only one benefit, death benefit. But then the government says that if you exceed this certain amount, so if you make it too efficient, I put in $1 million and I have $900,000 available. They would say, well, that's a MEC. It's not life insurance. There's nothing at risk. And therefore, it acts like a qualified plan with all the taxation, penalties, rules, etc. Right? But with the, but there's if you fly right under that MEC line, then the policy is as efficient as it can be without becoming a MEC. So when I look at this, it's playing by the rules, so to speak, right?
Yeah.
Now, here's the crazy thing is as dividends may fall, your policy could become a MEC. I've seen this with companies that have had dramatic decreases in dividends. And if you put a term rider on these policies and it's not flexible, well, could that cause a MEC?
Yeah. What about these people that say, oh, well, you can just convert those term riders?
Yeah. Now, I always think that's funny. You see a lot of people on the internet that are talking and think they know infinite banking, but they obviously don't because they say you can convert those term riders. And if I convert that term rider, Nick, what's going to happen?
It's going to MEC the policy.
Going to
Now,
MEC the policy. In fact, one of the actuaries with the insurance company, one of the companies that we use a lot, said that you have to wait 7 years because of the 7-pay test after the final PUA payment to make sure that it's not a MEC,
yeah.
right?
And technically, it is convertible. It's not incorrect to say that it's convertible. It's just that if you do that, you are likely going to MEC the policy. So just be careful of the noise out there on the internet.
So, the 7-pay test talks about the cumulative premium that you can pay, right? Over a 7-year period, the first 7 years of the policy, right? Is and it's about how the policy would be paid up in 7 years. And it really, we have to take the material that they're talking about and put it in practical terms. The company won't let you, they will notify you that, hey, you're going to MEC the policy. But what if it's just like these universal life policies? You have this plan in your head of here's how we're going to fund the policy, and then something changes, right? And if you had a material change, then so it's when the policy opens or there's a material change. So if you had to change the policy because let's say dividends went down and what if you had to increase the term rider so that it wouldn't MEC? Will a company allow you to do that? Maybe.
Maybe. What if you're not insurable?
What if you're not insurable? There's all kinds of things where this can really set yourself up for failure.
Well, you just took the words out of my mouth, Jim. We when we get asked about universal life, it's, hey, we can create a system for you where failure is an option or not an option. But
Absolutely.
what's coming to be clear to me is the people out there pitching 90-10. You're putting a lot of moving parts in there now. Um, its build is making you more flexible, but I believe that that's actually going to turn out to not be the case. And now you're really starting to introduce failure as an option in your system. And the whole thing misses the complete point of what Nelson talked about in his book anyway, but I won't go down that rabbit hole.
Yeah, absolutely. And Nick, one of the things that I think is an important message in this chapter as we wrap this up and move on to chapter 7 is that the wealthy never lost faith in putting their money in whole life insurance, but they told the middle class and the common person not to do it.
Yep.
Now, it's because It's just like with real estate today. Hey, don't tell everybody that if I buy real estate, I can depreciate the real estate while it's appreciating in cash and value, and it's cash flowing. Don't tell everybody that. I don't want them to know that.
Yeah. So you asked me a question when we met 7 years ago, whenever that was. We were talking about people that make over $100,000. Okay, and well, I'll just use that as a dividing line. But you said, "Hey, is that common or uncommon money?" And I didn't know what the heck you were talking about at the time. My brain wasn't engaged in thinking like we think now. But the answer to the question is that's an uncommon amount of money. And then you asked me, you said, "Well, do you want to do common or uncommon things?" If you're making an uncommon amount of money, why would you do common things with your money? And the common way is to go find a good money babysitter and do whatever they tell you and hand all your money over to them. But if we want to be uncommon, if you're making an uncommon amount of money, you need to do the uncommon. And that's what the wealthy are doing. So looking into this and doing that, looking at these policies, building out your banking system, that's where the freedom is. That's the uncommon, right? The road less traveled, the narrow door. Going and finding that is the key to freedom. And we always say money buys choices and choices buys freedom. And helping our clients use this, understanding the history, where we came from, so that they can create passive income that meets or exceeds their ideal standard of living. That's where we're going. That's who we're talking to. And if that's what you want to build for yourself, then we're here to help you.
Absolutely. Okay, so Nick, I think that puts chapter 6 to bed. Any famous last words or final thoughts before we move on to chapter 7 next episode?
No, I think we've covered it. We again, uh, if you want to discuss this more in depth, if you want to discuss your system and how you want to build it out, go to createtailwind.com, click on the contact us button. We'd also appreciate if you would go and rate this podcast. And I think that 5 stars is the highest rating, and it's frankly the only appropriate rating for the content and value that we're delivering you.
Absolutely. That would be great if you rate us 5 stars. We would appreciate it. Until next time, this is, we're laying the groundwork with this series of how and why infinite banking, why assets, not instruments. And hopefully everybody's enjoying this series and learning something. I would also encourage you to read the book after you've listened to the series, or while you're listening to the series, or read it again if you've already read it. And Nick, until next time, thank you very much for joining me. Let's wrap this up. And the way that we always wrap it up is you have to break away. Think about the government, the banks, and Wall Street controlling your life and your money. If you don't break away from that, I promise you it's not good on the other side, right? There's only one thing that happens to the herd, so let's break away. Thank you.
Here's the key to success and the key to failure. We become what we think about. Now let me say that again. We become what we think about.
Once again, thank you so much for taking the time to hear what was shared on today's podcast. If you are looking to discover new wealth building strategies, join our free online community and get access to free courses and in-depth training videos designed to help you build wealth and break away from the herd. Click the link in the show notes to access the community today. Thanks again for listening.